Hi, everyone. Welcome to another episode of the LATAM Stocks Podcast. I'm your host, Patrick Flood. Today, I'm speaking with Scott Freeman. Scott's an investment analyst at Variant Perception, which is an investment research firm that builds predictive investment models. They've shared some really interesting charts about Latin America covering, macroeconomics, equities, some of the relevant commodities. So I'm really eager to talk to Scott and learn about, some of their research as it relates to Latin America and his current perspective. So let's do it. Hi, Scott. How are you?
Hey Patrick, I'm doing well. Thanks for having me.
Yeah, I'm really excited to talk to you. I enjoy the research you guys publish, and as it relates to Latin America, I'm excited to hear what you have to say. So let's start off and learn a little more about you, though. So where are you from? Where'd you go to school? How'd you end up doing investment analysis at Variant Perception?
Yeah, so I'm from Ohio. I'm based in London right now, but I grew up in Northwest Ohio. I went to Ohio University, so not Ohio State, the little bit smaller, the Mac school. And then right after college, I started off in the wealth management industry. I moved out to Colorado. I was with a firm out there for about 3 years doing investment research, portfolio management for high net worth individual clients. Had another short stint at a very similar RIA type shop. And then actually through a former boss who is a Variant Perception client, he put me in contact with Variant Perception, and I joined VP in September of last year, so going about 9 months. And yeah, we're a small team of about 10 people, I'd say, and we my boss, our CEO is based in London, which is what brought me over here.
Okay. And now you have a Latin American connection, right? So you spent some time living in Mexico as well?
Yeah, so the silver lining, I feel like, maybe for you as well with moving down to Brazil, but the silver lining for COVID for me was that I moved to Latin America, and I started off in Ecuador. I spent about 3 months there, and then I was traveling through Mexico, and I met my wife, who now is my wife. She's from Puebla, and I lived there for about 2.5 years. And when I joined VP, it was remote. Everyone we're a dispersed across the world company, but I was based in Mexico to start, and now have just recently relocated over to London. So very familiar with Mexico, and love Mexico. It's a great place.
So what were your impressions then from someone that does investments and as you're traveling around, like what did you think of the region? I mean, did it intrigue you? Were you surprised by anything?
Yeah, with Latin America, I feel like, maybe this is just a cliche for, or I don't mean to bash my family, but whenever I'm back in Ohio, and people would always ask me, like, isn't it dangerous? Like, isn't it just, like, how do you like living there? And it's an amazing place with an amazing people. And I feel like it's relatively misunderstood, potential investment opportunities and the economic growth and, the talent pool that's building within the entire region, whether it's Mexico, Colombia, Brazil, you name it. And I think, at least at VP, we share that view, and we can dive into, our capital cycle framework later. It's been an underinvested region for the past decade, and we see
Yeah.
an unbelievable opportunity, whether it's in Mexican, infrastructure, the Brazilian commodity sector, you name it. And I'm grateful to have lived there because it gave me insight into the risks involved, which are, very political in a lot of ways, which we can also dive into a bit. But yeah, I think it's an unbelievable opportunity. And I think over the next 30 years, I'd argue it's the best geographic region to be investing in.
Yeah, I'm with you. I think it's wildly misunderstood, like you mentioned. I mean, and people kind of look at it on the surface and go, "Oh, it's too dangerous," and they ignore it. But that's not necessarily the reality. It's huge, right? Like Brazil's the size of almost the United States, the continental United States. So there's various regions, and they're diverse in every sense of the word. So I think it might help before we start getting into some of the specific market stuff if we talk a little bit about variant perception, because you guys have a heavy data-driven approach. So can you just tell me, what do you actually do? Who are your clients? What's your investment universe? And then maybe tell me more about like the investment style and philosophy of variant perception.
Yeah, so I guess how I would describe VP is, we are students of market history, and essentially we try to then make models of what our understanding of history is and to try to predict the future. We aren't gurus. A lot of times you'll see, individual research firms have a very, key man that or key woman that is, very public and vocal, and they're considered like, oh, that person has an expert take on this because it's their firm. And we are not like that. We approach things from a first principles standpoint, and we try to model it and then let the models tell us where we should, be allocating capital. We don't manage money. We just provide research. That's a big goal for us over this coming year is we eventually want to try to launch, a fund. But, for the past over 10 years, it's been just a research firm. And now we've really built out a very interactive portal where you can access all of our models from, a tactical, which we call a 1 to 3 month time horizon, for the more one of our main client types, which I would call is like global macro trading hedge fund type clients, to the cyclical and then the structural. So cyclical being 6 to 12 months, understanding the business cycle, key turning points, whether it's within, growth and inflation, liquidity, understanding central bank policy regimes, et cetera, to the more structural, which is what we call the capital cycle, where has there been over and under investment within equity market that, key driver of long-term 2 to 3+ year returns. And that's much more focused towards, the asset allocator type client, big pension funds, et cetera. And then also through all of those lenses, we have single stock clients. So we go down to the single stock level. We cover over 14,000 different individual equities that we, all of our tactical, cyclical, and structural models apply to. So those are our 3 client types, and those are the 3 main time horizons of which we bucket the world.
Interesting. So most of your clients then are institutional capital, right?
It's all institutional, a few individuals here and there, but it's all institutional money.
Okay, interesting. Okay, so let's get into it then. You mentioned cyclical, and one of the charts you guys recently posted was mid-May, and you posted a copper chart of your fast money metric, right? And it showed copper's extended, and you basically were calling for a pullback, and you guys nailed the local top, right? Yep. Copper's been down since. So can you just tell me a little bit about your view on copper market, and then more about the model you guys used to make that call?
Yeah, so I guess to start from our view on copper and like real assets, commodities in general, from a cyclical to structural lens, that would be our biggest overweight, the heaviest overweight we would press in a portfolio. We have this whole thesis we call it the age of scarcity. Pretty much it's the Hyman Minsky politicizing the economy type view. As governments over time, like more and more power becomes concentrated, and they try to control, interest rates and debt levels are going up and inflation's going up. We think that will end the age of abundance of cheap credit, cheap labor that we've seen pretty much for the past 40 years, and pretty much be a reversal over the next on a structural time horizon. And in that type of environment, we think commodities are poised to do very well. There's been a gross underinvestment over the past couple of decades from an infrastructure, CapEx standpoint, you name it. So from a copper standpoint, obviously that's a net positive. So cyclically and structurally, very optimistic. But, that's why I think a very differentiating aspect of variant perception, especially for, if you're managing a portfolio on a 6 to 12 or 2 to 3 year plus time horizon, you need to have those tactical overlays, right? I think 2023 is a great example of that. So many people were calling for recession, including us at a point in time. But, equities did well. And you had to understand that, we could chalk it up to fiscal being probably the biggest driver of why risk assets did well, but you have to have these models that can help you understand when to get in and then when to get out of an individual trade. And with copper, year to date, the main model, our main tactical, it's a breadth exhaustion type model, is what we call LPPL, log periodic power law. Essentially, it was made famous by Didier Sornet. It's modeling herding behavior within asset markets. The idea that, if your neighbor buys, like if you see what your neighbor's doing and you want to follow trend, like you're going to do so. But then as that concept builds and builds and builds, and then one person leaves the party, you're like, wow, why is everybody starting to leave? And everyone rushes out. And within copper, we model things on our LPPL models. We have a 1 hour, a 2 hour, a 4 hour model. And then if all those, flow together, we get a daily signal, which is what we've been seeing on copper. You pair that with you mentioned our fast money. That is literally just another way to measure speculative flow within an asset. It's pretty much like the high level summary is, if a bunch of investors are crossing bid-ask spreads within an asset, are fast, that will increase volatility in the direction of the price move, which then, increases our VP fast money, our speculative flow measure. And we have a bunch of back tests that say on a 1 to 3 month forward basis, when fast money is elevated, forward returns are negative. So we had a variety of our different, tactical short-term signals go off on copper, which to us, was a good signal to take profits, and it worked out pretty well. But that doesn't detract away from our cyclical to structural, long-term bullish view on the space, but, got to play the game, right?
So for longer term oriented investors that are just sitting in spot, or the miners, they can just, weather the drawdown. But if you want to take profits on a leverage position, maybe it's a useful indicator.
Yeah, or depending on like if you have a 10% target weight within commodities, and maybe you have a max weight, which is obviously you have your min maxes, you're approaching your max overweight. If you get a bunch of tactical short-term sell signals, could be a good opportunity to trim back to your targets, whatever it might be. But yeah, I mean, it all depends on your time horizon, right? So a lot of factors can go in.
So longer term, though, you're still structurally bullish on copper.
Right. Like it is by far the biggest overweight to real assets and commodities, inclusive of oil and gas, copper, and gold are, the main three we cover. And we'd be, structurally overweight all three of those, 2 to 3+ year time horizon, also on a, cyclical outlook as well.
Okay. So let's talk about gold then, because it's often mined with copper. You're bullish as well. So what do you see in gold? It broke out from looked like a 10-year cup and handle pattern up 20% to 2,400-ish. It's pulled back a little. What do you guys see?
Yeah, so I think like whether it's gold, oil, copper, year to date, we've obviously extensive rallies, and we've seen tactical models, whether it's our fast money model that I just mentioned. We haven't gotten an LPPL bubble or climax pattern in gold, but we've seen all of these assets, kind of had this extensive rally, hit a tactical trigger, and then it started, we've recommended trimming or taking profits from a cyclical portfolio standpoint, just given the tactical signals we've gotten. Right now, I feel like from a cyclical business cycle standpoint, we have what we call growth leading indicators across, over 30 different countries. The diffusion of all of our country growth leading indicators continues to trend higher. I think around like 70% of our country growth leading economic indicators are positive year on year now. And that historically is a very pro or bullish signal for commodity prices, inclusive of gold. So I think, the tactical, I think that was about, back in March, mid-March, early April, we had recommended trimming gold. But, would I say like, get out of your position right now? No, just given the cyclical outlook we have. But we still really, really like gold, especially we just did a pretty large scale write-up or thematic write-up called The Limits of Fiscal Policy. Governments around the world are going to continue to issue debt. And before, practicing, fiscal austerity, they will change the system prior to doing that. Like there is, history tells us that governments are going to issue more and more debt. And as you see, gold, there's been, I think a really popular chart on Twitter is how gold's diverged real yields, right? You're seeing some of these underlying fundamental drivers of gold that are, it's now trading somewhat off of a fiat debasement risk, which again, like we want to hold that in our structural view, but tactically, this wouldn't be the time to add. It's pretty much where we're at. That's how I would describe it. Long-winded answer.
Yeah, no, interesting. There's an analyst I follow, Luke Roman, and he has a great line. He goes, people talk about the BRICS are going to launch a currency because they have a currency. It's gold. So I think that's
and that can be a whole nother, that can be a conversation for another day. But like I think we actually just put out on Twitter the other day too, like a really simple way that we kind of measure if we think there's an aspect of, fiat debasement risk trading with gold. We look at gold relative to all G10 FX pairs and to see if breadth is moving along with price. And the gold rally has been met with improving breadth, which to us is a signal that, maybe it's not just, a speculative rally, but that people are actually believing, there is fiat debasement risk. Just another way to potentially look at it.
Interesting. So the other market you mentioned is oil. Anything worth talking about outside of the framework you already mentioned?
I mean, a model that we really like, we have these 1 and 3 year VWAP support level. We build these, what we call VWAP support and resistance levels from the bottom up. And essentially it's what price did an investor get long over the past 1 or 3 years? And those just naturally then create very good support or resistance levels, depending where spot is trading relative. Oil, US oil had been trading pretty far above both its 1 and 3 year VWAP levels, but now we're starting to come back down to what should theoretically be a historical support level. Again, though, it seems like things are tactically stretched. We're not recommending adding exposure to any commodities right now. We would more so just maintain current exposure, I guess is how I would say. So no, I don't really have anything to add from a outside of what I've already said from a cyclical and structural bullish outlook, but don't really think there's anything to be done.
Okay. So you guys also have an election framework. that you've
Yep.
applied to Latin America, right? So a couple great quotes I pulled is LATAM elections tend to see large risk premiums ex ante, which are resolved after the results, which in other words, quoting you guys again, LATAM, buy the rumor, sell the fact.
Right.
So can you tell me a little bit about your election models in general and then how you've applied them to Latin America?
Yeah, so as I'm sure you're familiar, LATAM is famous for its swings in populism. More than any region in the world, you have two starkly different candidates running. I feel like maybe people think that, Republicans, Democrats in the US are very different, but in reality, they're pretty centrist relative to some of the candidates that you see within Latin America. And what we found is, especially within LATAM countries, the currency is the main macro mechanism. A lot of locals saving dollars, and there's extensible fear over what I would call a market unfriendly or more traditionally called like a populist type candidate, whether it's AMLO in Mexico. Leading up to an election, things sell off. So the peso will weaken extensively. Equity markets will sell off. Credit spreads will widen. But historically within Latin America, and especially when there's tight races between the two candidates and within our framework, we had to say that either a market friendly, the more centrist, pro-business type candidate, and then the populist, more radical, leftist type candidate received more than 25% of the vote is what we called it was a contentious type election. Leading up to those elections, everything would sell off. And even if the populist candidate or the market unfriendly candidate wins this election, right? Everything rallies back, is sell the fact afterward, right? Everything gets oversold leading up to the election because historically, I think, Lulu in Brazil in the early 2000s is a great example of this. What is considered populist candidate or market unfriendly candidate doesn't implement market unfriendly policies, but B, often then implements pro-business market friendly, policies. It's kind of like the saying, politics is like a violin. You grab it with the left, play with the right. That's a very, very, real situation within Latin America. And, it's held true throughout history.
Okay, so let's apply that then to Mexico because
Right.
they have an election coming up. Contentious, from what I understand, but there's a clear front runner, right? So I don't know if it fits the framework in terms of contentious, but have you applied the framework to Mexico's coming election?
Yeah, so I was actually I have the peso on my screen, and while I feel like Scheinbaum's been pretty clear ahead, and obviously over time polling data gets better, and she's been a pretty clear front runner for quite a while. But nonetheless, AMLO was a pretty clear front runner in 2018, and this framework still held, right? The peso has not sold off relative to like it has in history, at least from starting year to date. We're starting to see a downside a little bit, especially with the election coming up. I think it's on Monday, right? It's on the 2nd. But I think the key aspect to this would be, equities have kind of chopped sideways. The peso, chopped sideways to down. The peso is, up year to date, but has recently started, give back a little bit. The key will be within this framework, right? The risk is Scheinbaum going to be, she's obviously AMLO's protege, but will she, be independent? And, just like AMLO, AMLO had a couple interesting policies around airports, but he didn't really do anything to limit the make Mexico a market unfriendly type country, right? That's the risk within Scheinbaum that a lot of people are fearing with Scheinbaum. If history tells us that that won't be the case and things should, tend to rally back after the election, which, especially given our outlook on Mexico from a capital cycle standpoint, which again, we can get into in a little bit, would make sense to us. But I feel like this election might be a little skewed just given like you said, she's been a pretty clear front runner, but I think the framework still holds.
Yeah, I spoke with Sebastian Morales recently, and he's a private equity investor in Mexico. And he made the point that if you want to track Mexico's election, you need to be following the congressional elections because that's where the contention's going to be. She's the clear front runner if she wins, but to what extent she'll be able to implement or not implement these policies is going to be dependent on the congressional elections.
Right. And that's interesting because that's essentially what happened in 18. AMLO was expected to win, but then the Morena party dominated they got the congressional majority. But nonetheless, the peso, equities, everything still did then rally back after the election. It sold off briefly when he made that, I think the closing of the original airport project was within the first 100 days or something of his election 2018, but that was the only kind of blip on the radar, and then the peso strengthened, equity markets rallied, et cetera, even though he won and Morena gained control of Congress. So we'll see. I would make the bet that history will hold, but LATAM can be kind of crazy now.
Yeah, I'm not surprised to not see that big of a sell-off though, too, because there's such a big structural tailwind in Mexico with the nearshoring that there's so
Yeah,
much investment money coming in regardless. I don't think those that are nearshoring their manufacturing necessarily care who wins the election. They're going to do it anyway for
right.
geopolitical reasons. So I think that's kind of a
Yeah, I
price
mean that can be
insensitive
simple.
bid for Mexico.
Like Mexico, surpassing China as a front runner and or as bigger trade part of the U.S. When you just go to the outside like Monterrey in the countryside, you see like all of these manufacturing villages being built, which are essentially all
Yeah.
these like Chinese immigrants now coming in to like circumvent trade restrictions with the U.S. and there is a big geopolitical or tailwind in that regard as well, so that could be offsetting some things.
Yeah. And then I think it's been mixed too. Like you mentioned that AMLO hasn't been particularly unfriendly. I think it depends on the industry, right? Most investment I have in Mexico is in miners, and
Mm,
they've been absolutely brutal. I mean, they've shut down permits, and now there's talk about Scheinbaum banning open pit mining. And
mm,
I mean, that's a big deal. I mean, Mexico's 30% of world silver production. So there's those
mm.
that like to talk about the silver squeeze. And if they actually ban open pit mining in Mexico, that's a big hit on production.
So I guess where would you see then the best individual equity opportunity within Mexico right now?
You can probably buy the silver miners, right? They're heavily discounted. It's been known for a while. So like the major ones like First Majestic, they've been trying to diversify to Mexico as best they can. So I think they're still relatively cheap relative to silver because I think there's a structural bull case for silver regardless, even if Mexico production stays the same. So in terms of individual names, I've covered publicly First Majestic. That's probably not the best company. I mean, they're high cost relative to others. Who else do I
Yeah.
own in Mexico?
What do you think about like the airport groups? Like OMAB has been
You
on the
got
top
to
of our capital cycle score for a long time, and that's obviously been a contentious topic with AMLO.
Have you met Ian Bezic before?
No.
Reach
Mm-mm.
out to him. He's a great analyst. He lives in Colombia
Okay.
and he's nailed the airport trade. He's the airport guy on he's the LATAM airport guy on Twitter. Yeah, if there was anyone I was going to ask about the airports, I'd ask him. I think
Okay.
we might have talked about it. I interviewed him, a few months ago, and I think we
All
talked
right.
about the
I'll check it
airports.
out.
But
Yeah.
I'll pass you his Twitter after, but I would recommend following him.
Okay.
He's bullish from
Cool.
what
All right.
I
Good to know.
from the
It's
last
been a top of so many of our screens for so long, but obviously it's been a geopolitical asterisk next to it. So that's been okay. Good to know.
Okay. So is there anything else from an election perspective? Are there any other elections in Latam you're following? I know Brazil's done. Argentina just happened. I
Yeah,
don't
I
think.
mean, no, I don't. It's just pretty much Mexico this year. Yeah, I mean, that's been part of like we've liked the outlook for Chile in general because it seems like is it Boric, right? Or Boric? Like the geopolitical risk surrounding him has died out somewhat. But no, like it's pretty much just been Mexico. And I'm really interested to see how things start to trade next week based around our framework.
Yeah, the Chile one was weird for a while to follow. They abolished their constitution and they were
Right.
going to rewrite it, right? And they thought that, oh, we got a leftist president, it'll be a leftist constitution. But I think that once they started doing it, it ended up being a more right-wing constitution than what they abolished.
It's kind of the classic like utmost like pension assets had like been depleted, but then it was pretty much an overreaction and then nothing ever really manifested, and it's kind of that was a classic kind of like LATAM presidential cycle, I would say. Yeah,
And it plays out over like 3 years, right? It doesn't happen quickly.
yeah,
There's the news, and
exactly.
then it's still going on. I don't think, at least last I checked, I don't think they have a new constitution yet. I think it's still
Yeah, I think
happening.
it's kind of ongoing, but I just feel like the geopolitical risk has faded for sure. Yeah,
Yeah, for sure.
presidential.
So then let's talk about your capital cycle framework, because that
Yeah.
really interested me, especially the capital scarcity, because, I argue Latin America is underinvested and underfollowed. And your work actually kind of showed that. You guys mentioned that you view Latin America as very capital scarce. So tell me about the framework. What do you mean by capital scarcity? And what can you use it for?
Yeah, so a lot has been written about the capital cycle. It was made famous by Marathon Asset Management, and it's pretty much this like if you have too much money chasing the same opportunities, that overinvestment is a destroyer of future returns, right? And when an industry is, we measure capital scarcity. We have three, and this is public on our website. You can see like our understanding the capital cycle framework. We measure it by looking at CapEx and R&D as a percent of assets, meaning, this looks at the outlay made to maintain and like expand an industry's asset base or like IP or intangible assets. And when that's high, it's just a lot of capital is flowing into the industry, e.g. capital abundance, right? Same thing, kind of similar for D&A as a percent of assets, identifies how quickly the asset base is being depleted. And then also we look at return on invested capital, high marginal return and high marginal ROIC on capital implies capital scarcity, which, suggests incremental capital inflows will earn higher returns. So you look at Latin America, out of any region in the world, it stands out as being capital scarce, meaning it's been underinvested relative, to the rest of the world over the past, 10 years, 15 years at this point. We cover equities, we do this at the industry level. So it's not down to the individual stock. We do it at an industry level, whether it's Brazil, Mexico, you name it, everything appears to be very capital scarce. And especially given, the age of scarcity thesis I had mentioned, giving Latin America has a, beneficial setup within commodities, we really, really like the outlook for Latin America in the long run.
Why do you think it's been so scarce in Latin America? Is it just a function of capital flowing elsewhere? FANG stocks, Magnificent Seven, whatever they call them now.
Yeah, I mean, also, I feel like there's been such bearish China news recently, but you forget that was a pretty positive, positive trend after the GFC. But I honestly haven't thought through other than, the geopolitical risk potentially that I had mentioned in, within the election framework. But now I think given, the nearshoring, which, I believe is going to be, a secular trend over the next decade, and, the U.S. in the world looking to move away from China as a main manufacturer of goods and a supplier of products, I think, you're going to start to see capital flow into the region. Yeah, but I would probably have to just chalk it up to geopolitical risk would be the main, and the infrastructure not being there for foreign investment, but I think that's all improving.
Yeah, no, the China one's interesting too, because people would always make that argument. China's slowing down, so it'd be bad for Brazil, but 25% of Brazilian GDP is agriculture. And
right.
I don't care what's going on with the economy, they're still going to eat, right? They still have to feed 1.4 billion people, and the agro industry in Brazil hasn't stopped growing. It's a, 4% CAGR for 25 years, right? It just grows a little every
and
year.
now also the agriculture's solidified itself as a secular bullish trend, but also the oil market. I think you go back to Brazil in 53, it was what was the campaign, this is our oil, or keep our
also.
Yeah, exactly. And then now in 2016 that flipped, and now oil is actually a pretty decent 1% of total exports, I think, or that's a misquote, but oil is a structural positive contributor to the Brazilian economy now. And I feel like that trend is going to continue forward. You know better than I in that regard, but
yeah, I talked to paraphrasing all my interviewers because they know more than I do. But
sorry, and it was oil there's a greater than 1% oil trade surplus as a percent of GDP. That was the quote I was going for.
So Federico Nobri is the analyst I interviewed, and he covers Petrobras. I think he's the best Petrobras analyst in the world. He used to cover him for Reuters, and he told me before, he now covers him as a head of research at a Brazilian brokerage. But he told me that regardless of any new investment or new production discoveries, anything, Brazil will be the 5th largest oil exporter in the world by 2030.
Wow.
Just what's going to come online. So that's a big deal. I mean, that's a huge boost for the economy. And they've also found a ton of new oil up in the Northeast. You follow the Venezuela talking about invading Guyana. Have you seen that?
Yeah.
Guyana basically has this enormous offshore oil reserve. It's the only thing. It's the only thing they want is the enormous offshore oil reserve. Well, right next to it's a bunch of Petrobras and American oil company assets, right? So theoretically, Brazil has some of that oil too. They just haven't fully explored it yet.
Yeah. Do you think is the Brazilian political climate sound enough to capitalize on that opportunity, or do you think there's underlying geopolitical risk that could?
Petrobras is such a weird one because, like you mentioned, they used to campaign on it in the 40s. So it's petroleum. Also, it's a emotional issue more than anything else for Brazilians, and they changed the politics of it. It's a political appointee now that's the CEO, I think. So for Petrobras specifically, I don't know what to make of it. Short seller Jim Chanus had a great quote one time that Petrobras isn't a company, it's a scheme. Which is so I don't know how to unpack it. I just know they have a lot of oil. And if you have that much oil and you're exporting around the world, it's hard to screw it up completely. Yeah. So I think they have a lot of leeway, even if there's a bunch of gaffed. And it's hard to imagine Brazil doesn't benefit from being the 5th largest oil exporter in the world. But I don't know how to play it relative to the oil companies here. I'm not sure.
Yeah,
I've never owned Petrobras.
Outside of oil and gas, you look at the Brazil, we calculate, again, from the bottom up industry standpoint on MSCI Brazil, our top line level MSCI Brazil capital cycle score is actually negative, but it's all being driven by banks because I think banks make up between 15 and 20% of the ETF. But you look at all these other sectors, whether it's personal care, food and bev, chemicals, you name it, so capital scarce. And our cyclical growth LEI for Brazil is continuing to turn up. there's so many cyclical and structural trends for the region that it's an extremely attractive investment
There's
opportunity.
so many domestic, like mid and small cap stocks that are just great businesses, great brands, and they just get stuck when the capital flows in and out, right? Like it's 50% of Brazilian volume on the Brazilian equity markets, foreign investors. So
Yep.
they pull the capital and everything goes down.
Yep.
And, these domestic companies that are really good companies are just trading dirt cheap price to earnings, dirt cheap valuation metrics.
Yeah, and EWZS is a pretty interesting way to play the Brazilian upside because I think financials or banks only make up like 3% of the ETF. And like, again, very high ranking on our capital cycle score metrics. So another good way to play things.
EWZ is the dollar denominated equity
Yep.
ETF, right? Yeah.
Yes.
Yeah. The hard part with that is I feel like if you look at the chart, it's kind of just muddled along while the local markets made new all-time highs. And I think you're taking I've never looked at it, but I don't know. Be curious to know what percentage of returns are driven by FX fluctuations versus actual equity market returns.
Yeah. I'm not sure. Yeah.
Like I feel like most of the time you're actually just buying the Brazilian real versus the dollar when you buy EWZ, which I don't
Right.
want to do on a long time frame, but I would want to own Brazilian equities. But I have a different, most international investors, I'm very happy to just make money in reais because I'll reinvest here. Whereas most people, if you want to take it back in dollars, it's a different calculation.
Yeah.
So what else? You also mentioned specific industries. You mentioned a few weeks ago, what was the industry? Consumer with the AFIA. You tagged me in it. It was, I'm trying to find here. I noted it. Consumer services. You highlighted LATAM consumer services as an attractive industry. So what?
Oh, yeah. So that was, again, we share some of this with you. Like our capital cycle score, we calculate it on, industry by industry across regions. And right now, like we have it had triggered that we had hit, the capital cycle score had improved by a certain amount. It's extremely positive within Latin American consumer services. And I think we cover, like I said, so many different industries across the world. I think we had just put that out because it had recently triggered. I don't necessarily have an underlying view on LATAM consumer services. It more just bakes into the broader, LATAM bull thesis that we have. But I mean, you name it. I'm looking at whether it's transportation infrastructure, which, I mentioned Mexican airports are the biggest individual names within that sector. You look at chemicals, food products, diversified consumer services, beverages, like semis, like everything across the space, pretty much stripping out banks is very capital scarce, which is why we like the space.
Yeah, I thought it was so interesting too that you guys took it from an industry perspective and then you went in and you looked at the specific equities, and then you started looking at single names based on the industry that your model identified, and then you can look at, instead of just buying a basket, you can rank order the individual names.
Yeah, no, what I can do too is I can get you on the VP portal, and within we have a single stock tool that you can literally filter by region, country, and then filter by capital cycle, crowding, all of our individual proprietary metrics to go from the top down all the way to the bottom to see where the best individual investment opportunities, which is, again, like I said, our single stock type client, that's what they use our portal for.
Yeah, I thought it was really interesting, especially since it flagged a company that I had covered, AFIA. It flagged.
Yeah, exactly.
So I thought that was really interesting. Different way to come to a similar conclusion about an investment. Does capital scarcity tend to mean revert, or is it a persistent trend?
So we use capital, the capital cycle score. It's a structural 2 to 3 year plus outlook. So no, I would not say we view it as a mean reverting. It might in very long waves, but that's what we often pair our capital cycle score with what we call our crowding score, which is essentially it's a measure of kinetic energy. It's a combination of our VP fast money, EPS estimate momentum, buy recommendation percentages, active funds, overweight and underweight within individual equities, which essentially helps gauge, risk around key events. So companies that have very high are crowded, they're very popular around a Fed meeting are more prone to larger downside moves than uncrowded names, which we use that as a pairing of a mean reversion type metric with capital cycle. We do a bunch of these 2x2 outlier type charts, and that's what we usually pair with capital cycle to try to identify the best type of investment. So no, to answer your question, we're not viewed as a mean reverting.
There's no reason to think that because Latin America has been scarce that a influx of capital is imminent. It's not cyclical in that sense.
Yeah.
No, makes sense.
Yeah, exactly. And valuations are not part of our capital cycle metric either, PE, right.
Yeah. Do you model any of the valuation type stuff in a different model? You guys use valuation, traditional value investing metrics at all or no?
I mean, not really. Like I mean, I feel like it's been fundamentally proven that like how does a price to earnings of 15 project future profitability, right? Like it just I don't like we use like like EPS momentum and like buy recommendation type percentages, some are
Mhm.
underlying calculations, but it's more so to gauge popularity, right, than actually deriving the underlying value of a stock. Like a framework that I really like that we've used at a very high level is like the Demoterin, like cash yield type valuation metric to like derive fair value S&P because it's inclusive of both dividends but also buybacks as a percentage of free cash flow to try to see where the S&P or top line market's trading. But no, from like we don't really ever touch the more traditional price to earnings, price to sales. We use capital cycle crowding and then a lot of technical underlying measures in addition to all of our business cycle cyclical framework to derive value within equities, or we see the
Interesting.
opposite, I'd say. Yeah.
Interesting. So is there anything else we didn't talk about related to, your models or any of the LATAM markets that we could touch on before we wrap up?
I don't think so. I mean, I think the key within LATAM is just, it really is the capital cycle story, which we cover pretty extensively. And, I think better than anyone else, it's a somewhat under misunderstood market. You need to monitor around geopolitical risk events, especially around elections, because that's when things can get somewhat hairy. But no, I mean, yeah, I think we pretty much covered everything.
Awesome. It was a really interesting conversation. So where can listeners find you, follow your work, learn about variant perception, product offerings? Where should I send them?
Right. So, variantperception.com, and also it would be our portal, which is portal.variantperception.com. We have a lot of things that are public on there, especially like our understanding white papers on our different models, whether it be capital cycle or crowding. We're also, pretty active on Twitter, which also we have links to, our white papers, et cetera, which is at VRNT Perception on Twitter. And that's where you can find us, a website and on Twitter. And we have a Substack blog that we put some things out on, but mostly active on Twitter and then our website.
Cool. Well, I'll post all that in the show notes for anyone that wants to find it easily. Thanks, Scott.
Perfect.
It was really interesting.
Awesome. Appreciate it, Patrick.
Be good.